So in this video, we're going to talk about the accounting equation, the famous assets equals liabilities plus equity. In this video, we're going to look at assets, liabilities, equity, and then we're going to really discuss the balancing act at play with this formula and why it's the cornerstone of financial accounting and accounting in itself. After that, we're going to look at Isma Mangoes, my mango company, this imaginary case study that we're going to use to actually give a human touch to this topic and make it simple for you, such that when you get on your exam, you're able to ace it. Or when you want to use this in your professional life and in your business cases, you'll know where to start. So let's get right into that. So assets plus liability, equals liabilities plus equity is probably the cornerstone of all things financial accounting. It's extremely important to understand. Before we even get there, we need to assess, well, what the heck is an asset, what the heck is a liability, and what the heck is equity? And I think the best way to break these things down is to put them into a human perspective. So when we're talking about assets, how do we understand that? Assets are really a tool that will provide economic value and or economic benefits to an entity, an accounting entity, in other words, to the company, okay? So assets are tools, resources that will provide economic value or economic benefits in the future of an accounting entity. An accounting entity could be anything from a company, anything from a person, an institution, and I'll throw a few names at you. Myself, I could be an accounting entity. Nike could be an accounting entity. Gatorade could be an accounting entity, all right? So that's just a really accounting way to say, hey, we're looking at a company and we're looking at finance. We're trying to see how these assets are going to work for them. And just to throw it at you, an asset could be anything from cash, property, inventory, merchandise, prepaid expenses, land, equipment, quite a lot of things, okay? So that's what you really want to put in perspective. And assets are crucial because they, once again, will create future economic benefits for a given accounting entity. And I'd like to double down on that future economic benefit type of thing. I feel like it's a buzzword. I feel like a lot of people would think that's kind of cute, but future economic benefit really could be boiled down to something as simple as this. I'm giving you a lesson right now. And at some time, lessons were a way for me to earn economic benefits, i.e. cash. But for me to be able to conduct those lessons, I would need a few assets. I would need a few tools. I would need a phone to talk to students. I would need a mouse to use my computer. And I would need quite literally a computer to do my lessons. Then I can't do this in the street. I got to do this somewhere. So right now I'm touching my house. This house is an asset. So as you can see, all of these different tools, all of these different resources are assets that I used to incur future economic benefits for the accounting entity, i.e. for myself, Isma helps. So that's what an asset is all about. Let me say it one more time though. An asset, okay, is a set of economic resources which an accounting entity could use, right, to earn future economic benefits, right? As simple as that. Now, with that said, we can move on to liabilities. Now, liabilities is extremely interesting, okay? Liabilities, I would boil it down as simply being financing earned from creditors in the forms of debts, okay, and or obligations. But I'd also like to add a caveat. Liabilities, really, at the end of the day, what they are simply future obligations, an IOU, okay? So literally, you really want to think about it as, to put it simply, liabilities consist of future outflows of cash or future obligations to creditors and or individuals. Now, I'm going to throw at you a few account names, a few items that you may see in your financial accounting course, or just simply in accounting, that can be considered as a liability. The first one goes without saying: accounts payables, trades payables, notes payables, deferred revenue, accrued liabilities. These are all different types of liabilities that you may see, okay? Now, as I said, there are kind of two subsets to liabilities, which would be future payments that you would owe to creditors, which could simply be a loan that you took at the bank, a loan that a company has taken at the bank, a loan that a company has taken from another company, And it could be accounts payables, right? It could be you bought a bunch of things from a company and you didn't pay them yet. Well, now you owe them money. That's considered to be a liability. But another really interesting forms of liabilities that you will see often in your journal entry questions and your cases and in real life is really the subtle form of an obligation, which once again, I'm trying to stress this, I can't stress this enough, it's a liability. And as soon as you have an obligation in the form or in the realm of business and or in the realm of a transaction, as soon as you have an obligation, you must consider that a liability, like 99% of the time. Let me give you an example. Let's say we're going to go with Isma Mangoes. It's going to be the name of my company. All right. I love mangoes and I sell the best mangoes on earth. Okay. And I make juices with those. I make shirts with those. I do a lot of things with mangoes just because I love them so much. Okay. Now, let's say that I promised a group of companies in Montreal, where I'm from, and I said, you know what? I'm going to give y'all 10,000 mango juices. Okay. Pay me now, but I'm going to get y'all the mangoes one day in Lamont. All right. They paid me cash today. I got the cash. I'm happy. I'm dancing. But I didn't give them the mangoes yet. Because they gave me cash, technically I owe them some mangoes. That's an obligation. That's a funny and stupid way to say that I have now an obligation that is owed to them, right? That's a liability, okay? Very important to understand that a liability at the end of the day, all jokes aside, is an obligation to accomplish something in the future. That something that you may accomplish could be done in cash, but it could also be done in time and or services or products, okay? So we'll tie a bow to this idea is that to understand liabilities, you really need to remember that it consists of financing that is earned from creditors in the forms of debts and or obligations, okay? In other words, you're looking at some cash. Now, finally, the last portion of this beautiful accounting equation is shareholders' equity, or simply E for equity. Now, this one's really cool. It's very similar to liabilities, right? But now it's financing that you received from shareholders, okay? This is financing that you received from shareholders, okay? So this is essentially cash that you received from somebody that took a stake in your business, in your livelihood, in your corporation, okay? When we're thinking about shareholders' equity, there's also another realm that we need to talk about, which is what we're going to put it under when we're looking at our financial statements. It would be this idea of retained earnings, okay? Retained earnings is a function of something that we're going to look at a little bit later, which is going to be, that's going to stem from our statement of statement of earnings, i.e. our income statement, is that a retained earnings is a function of our revenues and our expenses, something that we'll talk about later. Because our retained earnings is a function of our revenues and our expenses, technically our revenues and our expenses will be a function of our shareholders' equity. And this is something that we could proof later, but I really want you to understand that when we're looking at this shareholders' equity and this equity umbrella, all right, revenue and expenses will also be within that. Now, why does this matter? Because and I'll take a step back. When I introduced shareholders' equity, what did I say? I said shareholders' equity consists of the financing received from shareholders, from people who have a stake in the company, in the institution, in the accounting entity. However, earnings are also within this realm of shareholders' equity because earnings are technically owed to equity owners, to people who own the business, right? Myself in my company, I am the sole shareholder, right? A shareholder is somebody that holds a proportion, a part of a whole of a company of the sorts. I'm the only one. So the money this makes, right, is the money I'm gonna keep. I'm not giving it to anybody else. My earnings are mine. It is part of my own equity, what I am owed. So when I look at my revenues and I subtract my expenses, I will get some earnings that will now become in my pocket. I will be coming in my pocket as being part of my equity. And by definition, revenues will be a proxy to earnings and expenses will be a proxy to earnings because you cannot have earnings without revenues and or expenses. I know that I'm talking about this a lot and I'll leave it at that. But I hope this is a good bridge to this idea of why revenues and why expenses, right, or income will be put into the umbrella of shareholders' equity. Okay, but just to give you more titles that you may see on your exam for the umbrella of shareholders' equity, we're looking at contributed capital, common shares, dividends payable, retained earnings, sales revenue, sales expense, wages expense. We're looking at a whole lot of stuff, and that's going to fall within the equity umbrella. Okay. Now, one last thing that I'd like to say though is that that's just a quick introduction, but let's move on to this idea of, once again, A is equal to L plus E. Assets is equal to liabilities plus shareholders' equity. Why does this matter? And once again, what is it? This is a formula, okay? So A must always be equal to L plus E. That has to be a rule to you, all right? A is always equal to liabilities plus equity. It's a formula. It's a golden rule that can never be broken, okay? It's kind of similar to what we learned back in the days in sciences in high school or physics, which was Lavoisier's rule. Okay, I'm gonna say it in French. Rien ne se perd, rien ne se crée, tout se transforme. Nothing gets lost, nothing gets built, everything just transforms itself. Same thing applies here with the accounting equation. You can't have assets without something happening somewhere else, right? You need your accounting equation to balance at all times, right? It has to balance, okay? So assets, okay, minus liabilities and equity has to give you 0, all right? That stuff has to be balanced at all times. I don't know how to stress it more than that, all right? And we're gonna kind of talk about this with a case study, with my famous imaginary, kind of concerning that I have an imaginary business in mind, but Isma Mangoes, not bad, huh? Isma Mangoes, once again, is the coolest mango company in the world, okay? And we're gonna use a case with Isma Mangoes to explain and kind of flesh out and give a human face to the accounting equation, to assets is equal to liabilities plus equity, all right? So let's put some context to this. So I'll use my screen and we're gonna write it down together. So we're gonna have Isma Mangoes. All right, Isma Mangoes. I hope this is big enough. Yeah, so we have Isma Mangoes. All right, we're a new company, and how we're going to conduct our business is going to be simple. We have mango stands across Montreal. If you don't know where that is, that's in Canada. Okay, we're going to have mango stands in Montreal. All right, it's a new company. We have mango stands and we sell a few things. What do we sell? Well, we sell mango juice, we sell fresh mangoes, and we sell t-shirts with the smell of mangoes. We call that mango aroma. This is hilarious. But yeah, so that's our business. So we sell 3 types of products, okay? And we have mango stands across Montreal, and that's where we meet our customers and we sell them our product. Now, what would be our assets for Isma Mangoes? What could we define as being assets, right? Let's kind of look at that together. And what can we define as being liabilities? And hopefully, this would give you a better sense of what this is all about. And we're going to build kind of like some scenarios to each, such that it actually kind of makes sense for you. All right. So this, I guess I'll move here. This I could just move like that. Okay. So yeah, we have our assets, liabilities, and shareholders' equity. Now, with the few examples that I gave you here, okay, that we are Isma Mangoes, we're set in Montreal, and we sell our products that are mango juice, fresh mangoes, and t-shirts with mango aroma across mango stands in Montreal, okay, like a lemonade stand type of thing. I want you to take some time. You could pause the video and think about what are assets that a new business like this would have, right? And once again, don't forget, assets are something that are going to provide economic benefit to this company. Like it's going to be worth having to be able to conduct our business. And what would be liabilities that one would have at the very beginning? And what is the equity within that realm? You don't have to have a fully correct answer, but the idea is that you want to kind of try it out to see, well, how do we build some sort of intuition here? Okay. So I'm going to just list a few things. Assets that we could have, for example, would obviously be our inventory, right? We have an inventory of mangoes, right? An inventory of mangoes. We need an inventory of mangoes to be able to sell mangoes. For example, it could be 1,500 mangoes that we have in inventory right now that we're using to be able to conduct our business. How the hell do we make mango juice with mangoes? And how do we sell mangoes to people? Well, we need a mango. We can't give them a lotion instead. Got to give them mangoes. So inventory is super important. It's an asset because with that asset, with these inventories full of mangoes, we're going to be able to conduct business and sell them or create products that we could sell to people. Okay, that's what this asset's all about. But then another asset that we could have in this case would be a stand. We have a stand, right? That stand is going to allow us, it's going to be our point of contact to sell our products. That's an asset. Okay, then what about, let's say, another asset that we could have? We could have merchandise, our t-shirts, right? Our tees, as part of our assets as well. So that's a funny way to just discuss a few types of assets that we could have. Now I'm going to throw at you another scenario is, what are liabilities that we could have? Well, because we're a new business, okay? Because we're a new business, the mangoes that we purchased, we couldn't buy them in full. We actually had to take some credit on it. We said, you know what, to a company in Morocco where we buy our mangoes, okay? Company in Morocco is where we bought our mangoes. We bought 2,000 units of mangoes. And we said, you know what, I'm gonna take them now and I'm gonna pay you later, okay? So now we have an accounts payable with Mango Morocco, okay? We have an accounts payable for, call it 20,000. That's a lot of money. Or call it $4,000, okay? We have an accounts payable for $4,000 with Mango Morocco, okay? For us to be able to conduct our business. That's an example of liabilities. And I'm gonna move it quickly to shareholders' equity. Because we wanted to be able, we realized that, oh shoot, my God, we just took $4,000 worth of mangoes that we're not able to pay for right now because we're not sure how much money we're gonna make with our mango stand. We went to go see our grandma and we said, hey, grandma, I got a business idea for you. Wait for it. Isma mangoes, huh? Am I right? Not bad. Your grandma's like, oh my God, you have something here. Let me write you a check. But she's not crazy. She may only have a few years on this planet, but she's like, I want a proportion of your business. And your grandma says, I'm gonna give you $10,000 for 10% of your business, okay? And that's what we call is shareholders' equity. Why is it shareholders' equity? Because we got financing for our mango business, for our mango venture, in exchange for a stake of our company, okay? That's what it is. So you could say that contributed capital from your grandma, from Mima, is $10,000, okay? And that's a quick introduction to what the accounting equation is. But before we go, I'm gonna just try to like maybe pinpoint how do we journalize this and what would this actually look like in our accounting equation. I mean, this is why you're here, right? If you're still here. Let's go for it. So let's say that we'll look at one for each type of examples that we brought up for Isma mangoes. Let's look at our inventory. So we have, okay, we have 1,500 mangoes, okay? That's our inventory. And we bought those mangoes, all right? So we got inventory. So we got, let's say, they're $1 per mango. We got $1,500 worth of mangoes, okay? That's how much mangoes we got. So these are assets. All right, we got $1,500 worth of assets of mangoes, okay? I'll even move this here. So $1,500 worth of mangoes. Those are assets. But in exchange for that, we had to do something, okay? In this case, remember, we said we didn't have cash to pay. I'll put this as an example to make it easier. We didn't have cash to pay for those mangoes, okay? So in exchange, we had to tell mangoes from Morocco, wait for it, we're gonna take a line of credit on this. We're gonna pay you back in a while, in like 20 days, 30 days or so. So in exchange, you got an accounts payable of $1,500. So what's really interesting here, this is obviously going to be a liability. What's really interesting here is that you got $1,500 worth of assets, but you also got $1,500 worth of liabilities, right? Assets is equal to liabilities plus equity. In this case, if we look at it, you had $1,500 of assets. It was equal to 1.5K of liabilities. And obviously, in this case, you had 0 equity for this specific portion of the example. All right. Now, finally, let's look at the final one quickly. We have like 20 seconds. Shareholders' equity. In this case, if your grandma gives you $10,000, she's giving you what? $10,000 cash, right? She's giving you assets. Cash is helpful for the business. You can do a lot of stuff with cash. So you got 10K worth of cash, 10K worth of assets, right? And you didn't get no liabilities. So you had 0 liabilities, but you definitely got some shareholders' equity now. Somebody now owns 10K of your business, such that, once again, it balances. 10K is equal to 10K. So that's a quick introduction to what the accounting equation is all about. It was funny, right? I hope, or maybe it was cringe, who knows? But I hope it was an introduction to what it is, and hopefully it gave you a more human perspective on what it's all about. Now, in the description below, you're going to be able to find some useful resources, some links, as well as documentation that you could use to be able to practice questions relating to the accounting equation. And maybe some things were wrong. Maybe some things weren't fleshed out enough. And maybe you feel like there should be more, or that something should be corrected. Let me know. I used to be a student not too long ago, just like yourself, or whatever the case may be. And we're always learning. And I use this as an opportunity to get better and not get, well, sound like a finance guru or like a fitness guru or a weirdo like that on YouTube. But I'm using this as an opportunity to flesh out my own understanding of these topics, and I do it in a funny way, hopefully to help you out and make learning a more human thing. And yeah, hopefully this helps. Au revoir.